Hey everyone! I'm just one person, hidden deep in the countryside, surrounded by silence, but I built BlockSonic to speak with the entire world. Here, you don't get noise. You get the pulse of Bitcoin, every single day, distilled into pure, essential updates. No teams, no sponsors, no filters. Just me. A signal from the quietest place on Earth, bringing you the most important Bitcoin news before the world wakes up. With BlockSonic, you don't need to search for information. I research, I write, and I tell the story behind every headline. I do the digging. I chase the truth. All you have to do is listen. Today, the news unfolds around a pivotal shift in the financial landscape as Bitcoin ETFs unlock new institutional potential. We'll delve into how the removal of trading caps on options is set to amplify the influence of major funds, transforming the crypto market from its Wild West origins to a disciplined Wall Street arena. From Binance blazing a trail in European crypto compliance to Ethereum's recent surge, we'll explore whether this growth is substantive or just a fleeting illusion. Meanwhile, Bitcoin's current tranquility amidst a gold rally raises questions about its next move. We'll also touch on Japan's inflation impact and South Korea's digital asset challenges, as well as the rise of gold and silver. Stay tuned as we navigate these dynamic markets and what they mean for the future. Bitcoin ETFs unshackled. Institutions poised for greater impact. Anticipate transformative shifts as institutional players gain new leverage. The landscape of Bitcoin and Ethereum exchange-traded funds, which have absorbed substantial institutional investments, is set for a significant evolution. The removal of an options trading cap heralds a new era of institutional influence on these digital assets. In a move anticipated by market observers, the cap limiting any single participant in trading options on US-listed Bitcoin and Ethereum ETFs to 25,000 contracts has been lifted. This change, filed by Nasdaq on January 7th and activated this week, allows for a more comprehensive hedging strategy by large funds and institutions. Options are financial instruments that permit speculation on future asset prices with minimal initial expenditure. They allow participants to secure a Bitcoin purchase at a predetermined price, potentially reaping future benefits. Conversely, put options provide a safety net, enabling holders to sell at current prices if the asset value nosedives. The removal of this cap facilitates deeper institutional engagement, particularly with BlackRock's Bitcoin ETF, EBIT, which is already competing with leading centralized exchanges like Deribit in terms of options activity. Without the previous constraint, these ETFs could dominate the options market. This development has already contributed to reducing implied volatility, transforming what was once a volatile crypto landscape into a more institutionalized environment. Institutions writing call options continue to hold ETF shares, earning premiums while maintaining a bullish stance through their spot ETF holdings. In terms of market dynamics, the past 24 hours have shown little change. Cryptocurrencies continue to underperform compared to precious metals, with Bitcoin and Ethereum seeing slight declines. In contrast, Tron's TRX has seen an upward trend, buoyed by Tron DAO Ventures' investment in River, a cross-ecosystem stablecoin system. Traditional markets show the dollar index steady at a recent low, while warnings from the Committee for a Responsible Federal Budget highlight the inevitability of fiscal challenges. As we witness these developments, we must reflect on the broader implications. The lifting of constraints on options trading for ETFs signals a maturation of the crypto market, encouraging deeper institutional involvement. How will this newfound freedom reshape the future landscape of digital assets? Share your thoughts and join the conversation in the chat. Binance's bold step, pioneering crypto compliance in Europe. Binance embraces regulatory clarity in Greece, aiming to lead in Europe's evolving digital market landscape. Binance has embarked on a significant journey by applying for regulatory approval under the European Union's cutting-edge markets in crypto assets regulation, selecting Greece as the strategic gateway. This bold move signifies the exchange's commitment to aligning with new regulatory landscapes while paving the way for responsible innovation in the digital financial ecosystem. The exchange has engaged with the Hellenic Capital Market Commission, the esteemed authority overseeing securities and crypto asset services in Greece. In a statement, Binance expressed enthusiasm about the MiCA regulation, highlighting its potential to enhance regulatory clarity, bolster user protections, and establish a robust framework for innovation. This collaboration marks a pivotal moment for the exchange as it seeks to contribute to the sustainable growth of Europe's digital economy. Establishing Binary Greece, a local holding entity, further underscores Binance's dedication to the region. Registered with €25,000, this entity aims to acquire and manage equity participations while offering financial advisory services. Such strategic initiatives reflect Binance's determination to integrate into the European market effectively. The application undergoes an expedited review process by the HCMC, with assistance from global advisory firms such as PwC, Deloitte, and KPMG. This marks a significant step in Binance's quest to regain its footing in regulated markets after navigating a challenging period in 2023, which included a $430 billion settlement in the United States and withdrawal from several European jurisdictions. The exchange's leadership, including CEO Richard Teng, remains committed to compliance and re-entering the U.S. market in the future. Reflecting on this development, we must consider the broader implications of regulatory frameworks like MiCA. They offer a structured path for innovation while ensuring that user protections and market stability are not compromised. This delicate balance between innovation and regulation is vital for the sustainable evolution of digital financial ecosystems globally. As we witness these transformative changes, we ponder: how can regulatory frameworks foster innovation while safeguarding market integrity? Share your thoughts and join the conversation in the chat. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Ethereum surge. Real growth or illusion? Ethereum's activity soars, but hidden traps may inflate its apparent resurgence. Ethereum's blockchain, known for its smart contracts, has seen a remarkable increase in daily activity, surpassing its cost-effective Layer 2 counterparts. This resurgence, however, comes with an intriguing caveat. The activity may not entirely represent genuine user engagement. The number of daily active addresses on Ethereum recently approached 1 million, peaking at over 1,300,000 on January 16th, before settling near 950,000, as reported by Token Terminal. This positions Ethereum ahead of notable scaling solutions like Arbitrum, Base, and UpMainnet, challenging the narrative of users permanently migrating away from the network. Active addresses are unique blockchain wallets engaged in transactions, such as sending, receiving cryptocurrencies, or smart contract interactions. Analysts monitor this metric to gauge network usage beyond token price speculation. Layer 2 scaling networks act as auxiliary routes to the primary Ethereum blockchain, efficiently handling numerous transactions at reduced costs and later consolidating them on the main chain for security purposes. Ethereum's activity rebound follows the December Fusaka upgrade, which significantly lowered transaction fees, rejuvenating direct on-chain activity, especially for stablecoins, a key use case for everyday transfers. At first glance, the figures suggest a return to mainnet phenomenon. However, analysts warn that raw address counts may be deceptive, particularly when reduced fees enable spam transactions. Picture spam calls inundating your phone. The call log appears bustling, yet most are nuisances, not genuine conversations. A similar scenario unfolds on Ethereum, where January's address growth largely stems from address poisoning attacks rather than organic adoption. Security expert Andrei Sergenkov highlighted a surge in dusting activities where attackers send minuscule stablecoin transfers to numerous wallets, aligning with the spike. Address poisoning manipulates human behavior. Attackers craft wallet addresses resembling a victim's, often matching initial and final characters. They initiate trivial dust transfers, typically under $1, causing the fake address to appear in the victim's transaction history. When the victim later copies an address from this history, instead of a reliable source, funds may inadvertently be sent to the attacker. Sergenkov's research indicated that new Ethereum addresses surged to approximately 2.7 million during the peak week of January 12th, about 170% above typical levels. 2/3 of these addresses received dust as their inaugural stablecoin transaction, indicating poisoning rather than legitimate onboarding. The attack has resulted in over $740,000 in confirmed losses, primarily affecting a few victims. The reduced fees post-Fusaka have rendered these campaigns feasible, enabling attackers to execute transactions en masse with minimal initial investment. The lesson here is not that Ethereum's usage is fictitious, but that headline metrics require context. While lower fees have undeniably revitalized mainnet activity, particularly for stablecoins, they also facilitate misuse, inflating address counts and transaction volumes. As we navigate this landscape, we must ask ourselves, how can we discern genuine growth from artificial inflation in a decentralized network? Share your thoughts and join the conversation in the chat. Bitcoin's quietude amidst a gold surge, a tale of divergence. Bitcoin's stability contrasts with gold's ascent as alternative digital currencies chart their paths. In recent market activities, we observe Bitcoin maintaining a narrow trading range, with its value hovering around $88,950. Meanwhile, Ethereum slightly decreased by 1% to $2,920. The broader economic landscape mirrored this steadiness as United States equities, specifically the Nasdaq 100 index futures and S&P 500 index futures, experienced minor declines of 0.4% and 0.25%, respectively. The allure of precious metals, particularly gold and silver, which continue their ascent to unprecedented heights, reflects a market inclination towards safety. This risk-averse sentiment is further emphasized by the recent trilateral dialogues involving Ukraine, Russia, and the United States, where investors remain skeptical about achieving a resolution. Despite the overarching narrative of caution, certain alternative digital currencies exhibit resilience. Notably, Layer 00 tokens surged by 12%, fueled by speculation of an impending upgrade in early February. Similarly, Tier X and Dash tokens registered modest increases of approximately 3%. This juxtaposition of stability in Bitcoin against the dynamic movements of altcoins and the flight towards gold invites introspection. It highlights the diverse mechanisms through which market actors navigate uncertainty and seek valuations reflective of their subjective preferences. As we ponder these developments, we must ask ourselves, in a world of decentralized choices, how do we best align our actions with our aspirations for order and prosperity? Share your perspectives and join the dialogue in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin's Great Exodus, a prelude to rebound? A surge in Bitcoin ETF outflows sparks speculation of a price revival. Bitcoin exchange-traded funds in the United States have witnessed their largest weekly outflows since the previous November, hinting at a potential turnaround for the preeminent cryptocurrency. In the span of 4 days, ending on Thursday, a net $1.22 billion exited the market, with substantial withdrawals of $479.7 million and $8.7 million on Tuesday and Wednesday, respectively, as reported by Sosa Value. Concurrently, Bitcoin experienced a 5% decline during this time frame and remains relatively unchanged since the year's onset. Historically, substantial ETF outflows align with local lows in Bitcoin's valuation. Last November, a similar 4-day withdrawal, totaling $1.22 billion, coincided with Bitcoin hitting a trough around $80,000 before it rebounded past $90,000 in subsequent days. A pattern akin to this was observed in March of 2020, amid the economic uncertainty stirred by President Trump's trade policies, when Bitcoin's value fell to $76,000. Likewise, in August of 2024, Bitcoin found a bottom near $49,000 during the unwinding of the yen carry trade. The average entry cost for ETF investors is currently $84,099, a level that has frequently provided critical support. This was notably evident during the November retreat near $80,000 and again in April of 2025. As we reflect on these fluctuations, we must ponder the recurring nature of these market patterns. Are these outflows truly precursors to a resurgence, or do they merely echo the cyclic nature of market dynamics? We invite you to share your thoughts and join the conversation in the chat. Bitcoin's roller coaster risks. Are rewards just not worth it? The latest metrics suggest that Bitcoin's volatility may not be delivering the expected risk-adjusted rewards, echoing past downturn signals. The current landscape of Bitcoin showcases a tumultuous ride that seems less rewarding than before. The Sharpe ratio, a tool often used by fund managers to evaluate if the additional returns of an investment justify its volatility risks, has turned negative for Bitcoin. This indicates a scenario where the wild fluctuations in prices are not translating into adequate returns. This decline is evident as Bitcoin has retracted to $90,000 after peaking above $120,000 in early October. The negative Sharpe ratio is reminiscent of similar patterns during the depths of previous bear markets. Some observers perceive this as a potential turning point, hinting at the end of the downtrend and possibly the dawn of a new bullish phase. However, the negative reading is not a definitive indicator of future market movements. It merely reflects the current risk-reward balance. Historically, the Sharpe ratio has provided insights into when risk-reward dynamics reset to levels that precede significant market shifts. Despite being oversold, the present circumstances might offer lower risk opportunities for long-term investments. This is not due to the impossibility of further price drops, but rather because the risk-adjusted setup is favorable. In past instances, such as late 2018 and again in 2022, the negative ratio persisted even as prices remained low during prolonged bear markets. Traders typically focus on the metric's trajectory after extended periods of weakness. A consistent movement towards positive territory may signal improved risk-reward dynamics, aligning with historical trends of renewed bull runs. Currently, Bitcoin shows no clear signs of a bullish resurgence. It remains around $90,000, concluding a week characterized by erratic volatility and underperformance compared to gold, bonds, and global technology stocks. In reflecting on these observations, we must ponder: are we witnessing a temporary dip in risk-adjusted returns? Or does this signal a deeper, more systemic shift in the dynamics of Bitcoin's market behavior. We invite you to share your thoughts and engage in this discussion with us. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin's volatility amplifies amid global market movements. Cryptocurrency faces uncertainty as dollar weakens and equities rise. Bitcoin, valued at $89,321.08, hovered just below the $90,000 mark during Asian trading hours on Friday. Despite gains in regional equities and a softer United States dollar, the cryptocurrency struggled to sustain its momentum following a turbulent week. The largest digital currency fluctuated around $89,800, showing minimal change in the session. However, it remained under pressure as it failed to gather strength after a week marked by liquidation-driven sell-offs. While Asian stock markets soared to record highs and investors shifted their focus to non-United States assets, cryptocurrency prices lagged. This indicates a more cautious approach towards high-volatility investments. Asian equities surged, with the MSCI Asia-Pacific Index reaching a new peak and emerging market stocks continuing their upward trend. United States equity futures showed modest increases ahead of the New York opening, although the rise was less significant than that observed in Asia. The dollar remained weak after a sharp decline earlier in the week, providing support for commodities and maintaining gold near $5,000 an ounce. This macroeconomic environment has steadied broader risk sentiment, yet the response in the cryptocurrency market has been muted. Bitcoin briefly dipped below $98,000 earlier in the week amid more than $1 billion in forced liquidations. Since then, prices have consolidated rather than showing a decisive rebound. Ethereum slipped towards $2,970, while major tokens such as Solana, Cardano, and XRP edged lower, according to market data. Most large-cap tokens remain down between 7 and 12% over the past week, highlighting the fragile sentiment despite calmer conditions in equities and currency. Market participants continue to perceive cryptocurrency as a high-beta extension of global risk appetite, reacting more to shifts in the dollar, bonds, and equity markets than to developments specific to cryptocurrency. Cryptocurrency is still trading as a volatility amplifier rather than a defensive asset, noted Wenyi Kai, Chief Operating Officer at Sin Futures. The liquidation flush cleared excess leverage, but uncertainty regarding policy, funding costs, and regulation is keeping investors selective rather than aggressive. The weaker dollar has historically provided some support for Bitcoin, but this relationship has been inconsistent, particularly when investors favor assets with clearer cash flows or yield. For now, cryptocurrencies appear to be in a holding pattern. As the United States session approaches, traders will observe whether the strength in equities and emerging markets will boost cryptocurrencies, or if Bitcoin remains pinned below $90,000 as confidence rebuilds slowly following a mixed start to the year. Reflecting on these dynamics, we see the intricate dance between market forces and human action. The interplay of decentralized currency and centralized financial systems invites us to ponder: to what extent do external market forces dictate the path of cryptocurrencies? And how can individual action carve out a niche within this evolving landscape? Share your thoughts and join the conversation in the chat. Japan's inflation ripples, Bitcoin and yen in the balance. Japan's inflation sees a shift as the central bank holds borrowing costs steady, influencing the global financial landscape. Bitcoin and the Japanese yen displayed remarkable steadiness as Japan witnessed its first inflation slowdown in 4 months. The Japanese central bank opted to maintain its interest rates, signaling a period of watchful anticipation. The headline Consumer Price Index, a reflection of daily living expenses, decelerated to a 2.1% year-on-year rate in December. This marked a notable decline from November's 2.9%, as reported by the Ministry of Internal Affairs and Communications. Meanwhile, core inflation, which excludes fresh food prices, eased to 2.4% from 3% in the previous month. Yet, the undercurrents of inflation maintained a persistent grip. Core inflation, excluding both fresh food and energy prices, only slightly decreased to 2.9% from November's 3%. Analysts from ING highlighted that despite fluctuations from energy subsidy programs, fundamental price pressures remain tenacious. In light of this, analysts suggested that enduring core inflation might prompt policy normalization. However, the deceleration in headline and core inflation could result in a cautious observational stance in the coming months. Subsequently, the Bank of Japan resolved to keep its benchmark borrowing rate at 0.75%, with near unanimous agreement. The central bank also revised its growth and inflation predictions upwards for fiscal years 2025 and 2026, attributing this to expansionary fiscal policy initiatives. Bitcoin's value remained largely unmoved, hovering close to $90,000. The Japanese yen experienced a minor decline, dropping by just over 0.20% to 158.70 per United States dollar. Strategic forecasts suggest the yen may remain weak in the near term, a trend that could negatively impact Bitcoin, given the recent strong positive correlation between the two assets. As of writing, the 90-day correlation coefficient between Bitcoin and the yen stood 0.84. The 10-year Japanese government bond yield increased by 3 basis points to 1.12%. Reflecting ongoing fiscal concerns and market expectations for continued rate hikes by the Bank of Japan, due to persistent underlying inflation and optimistic growth and inflation forecasts. This benchmark yield serves as a barometer for market sentiment regarding interest rates, prices, and economic expansion. Earlier this week, yields soared to multi-decade highs amidst apprehensions that tax reductions promised by political parties ahead of the February election could exacerbate the fiscal scenario. This surge in Japanese yields had a global ripple effect, elevating borrowing costs worldwide, including in the United States, thereby creating challenges for risk assets, such as stocks and Bitcoin. Bitcoin experienced a decline of over 4.5% to $88,000 on Tuesday and has since witnessed a modest recovery, trading near $90,000, with prices remaining largely unchanged over the past 24 hours. In reflecting on this unfolding economic narrative, we are reminded of the delicate interplay between inflationary trends and monetary policy, and their profound impact on global markets. As we ponder these dynamics, we ask, how do these economic shifts influence your perspective on global financial stability and personal investment strategies? Share your thoughts and join the conversation in the chat. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. South Korea's digital asset dilemma unveiled. Digital asset mismanagement plagues authorities as South Korea grapples with a lost Bitcoin cache in a phishing attack. The realm of digital assets often challenges individuals and exchanges, yet now, even administrative authorities find themselves ensnared in the complexities of secure crypto management. In South Korea's Gangju district, prosecutors are delving into the perplexing disappearance of a substantial Bitcoin stash, valued at $89,477, initially seized in a legal proceeding. According to reports from local media, an internal examination has unveiled the possibility that these digital coins were taken through phishing during their official holding and management phase. We are actively investigating the circumstances surrounding this loss and the current location of the seized assets. An official shared with Yonhap News, emphasizing we cannot disclose any specific details at this time. This incident underscores the persistent challenges authorities face in safely managing digital currencies, as phishing remains a predominant threat within the industry. A crypto phishing attack involves malicious actors deceiving individuals into revealing their private keys, passwords, or seed phrases by posing as trusted wallet providers or platforms. Such attacks are prevalent due to the decentralized and irreversible nature of cryptocurrency transactions. According to Chainalysis, crypto-related scams and fraud siphoned $17 billion from victims in 2025, with an astonishing 1,400% increase in impersonation scams compared to the previous year. AI-enhanced attacks have proven to be 4.5 times more profitable than traditional methods, fueling industrial-scale operations, utilizing phishing-as-a-service tools, deepfake technologies, and sophisticated money laundering networks. In reflecting on this, we recognize that the harmonious order often sought in decentralized systems can be disrupted by human errors and malicious intent. The question arises, how can we strengthen the integrity of digital asset management to ensure trust and security in a world defined by individual choice and innovation? We invite you to share your thoughts and insights in the chat. Gold and silver shine as Bitcoin stalls in the market extravaganza. Precious metals soar to new heights, leaving Bitcoin in the shadows of market volatility and investor momentum. In the unfolding narrative of financial markets, gold and silver have surged with remarkable vigor, nearing significant price thresholds, while Bitcoin, valued at $89,477.17, lingers around the $90,000 mark. As of the latest trading, Bitcoin remained largely unchanged at $89,930. Gold has edged close to $4,950 per ounce, marking an ascent of 2.5% within the day, whereas silver has surged over 6%, nearing $99. This rally caps a month of exceptional gains for these precious metals, with gold appreciating over 7% and silver soaring nearly 30%, surpassing the performance of most major asset classes. Prediction markets illuminate a growing consensus among traders that these levels are mere waypoints rather than definitive peaks. On the Polymarket platform, contracts evaluating whether gold or Ethereum will first reach $5,000 attribute a 97% probability to gold, with Ethereum trading below $3,000. Month-end prediction. Markets are heavily skewed toward scenarios where gold surpasses $5,000 by January's end, with minimal expectation for significantly lower prices. Silver markets echo this sentiment, demonstrating strong confidence in prices, exceeding $85 and significant positioning for a $100 target. Prominent analysts anticipate continued upward movement for precious metals. Notably, Goldman Sachs recently elevated its year-end 2026 forecast for gold to $5,400 per ounce, up from $4,900. For Bitcoin, traders on Polymarket foresee it maintaining a stable range around $85,000 throughout January. The backdrop of volatility explains the trajectory of this rally. Silver's 30-day realized volatility has escalated into the high 60s, whereas gold's volatility, although it has increased, remains relatively contained in the low 20s, indicating a measured and orderly price adjustment rather than a chaotic surge. In contrast, Bitcoin's realized volatility has compressed into the mid-30s, even as its price fluctuates near recent highs, underscoring a shift in how markets are navigating macroeconomic uncertainty. Reflecting on these developments, we are reminded of the dynamic interplay between human action and market forces. The ascent of gold and silver illustrates the power of individual valuation and the market's capacity to coordinate dispersed knowledge. Meanwhile, Bitcoin stagnation invites us to consider the underlying factors that influence stability and volatility in the digital currency realm. As we ponder these events, we are left with a profound question. How do we, as individuals, navigate the landscape of opportunity and risk in a world defined by spontaneous order and purposeful choice? Share your thoughts and join the conversation in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Crypto's transformative year. Navigating beyond market turbulence towards 2026. Resurgence. Amidst the tumultuous events of 2025, the cryptocurrency landscape faced severe trials, setting a stage for potential revival and dynamic shifts in 2026. Beneath the surface of what appeared to be a volatile year for cryptocurrencies in 2025, a deeper narrative unfolded. According to insights from the esteemed venture capital entity Pantera Capital, the crypto ecosystem grappled with a bear market for most tokens, a trend that began its descent more than a year earlier. In their outlook for 2026, Pantera Capital unveiled that the market for non-Bitcoin tokens has experienced a persistent decline since December of 2024. The aggregate market value of cryptocurrencies, excluding the flagship Bitcoin, Ethereum, and stablecoins, plummeted by approximately 44% from its peak in late 2024 through the end of 2025. This downturn significantly impacted market sentiment and leverage, reaching levels historically linked with capitulation, a phase characterized by panic-induced sell-offs where holders relinquish hope for recovery, opting instead to liquidate positions to avert further losses. While Bitcoin concluded the year with only a modest decline, Pantera highlighted that the remainder of the market endured a prolonged and largely unresolved drawdown, marked by extreme dispersion. Bitcoin ended 2025 down by approximately 6%, while Ethereum fell by about 11%, and Solana dropped by 34%. The wider token market, excluding Bitcoin, Ethereum, and Solana, fell close to 60%, with the median token experiencing a drop of roughly 79%. Pantera described 2025 as a notably narrow market where only a small proportion of tokens yielded positive returns. Pantera pointed out that rather than fundamental drivers, macroeconomic shocks, market positioning, flows, and structural dynamics dominated price movements. The year was punctuated by repeated fluctuations linked to policy developments, tariff threats, and shifting risk appetites, culminating in a significant liquidation cascade in October that wiped out over $20 billion in notional positions, exceeding the impacts of the Terra Luna and FTX collapses. Structural issues further intensified the pressure. Pantera emphasized unresolved questions regarding token value accrual, noting that governance tokens often lack explicit legal claims to cash flows and residual value available to equity holders. This dynamic allowed digital asset equities to outperform tokens throughout the year. On-chain fundamentals also weakened in the second half, with declines in fees, application revenue, and active addresses, even as the supply of stablecoins continued to grow. Pantera observed that the duration of the market downturn now mirrors prior crypto bear markets, potentially setting the stage for a more favorable environment in 2026. Should fundamentals stabilize and market breadth extend beyond Bitcoin? Rather than forecasting price targets, Pantera envisions 2026 as a shift in capital allocation, with Bitcoin stablecoin infrastructure and equity-linked crypto exposure poised to reap initial benefits if fundamentals stabilize and risk appetite resurfaces. In December, Pantera's Paul Ferradicate expressed that the firm anticipates 2026 to be characterized by institutional adoption, with growth concentrated in the tokenization of real-world assets, AI-driven on-chain security, bank-backed stablecoins, consolidation in prediction markets, and a surge in crypto initial public offerings, rather than a broad return to speculative token rallies. As we reflect on the unfolding narrative of the cryptocurrency market, we must ponder the deeper implications of these transformations. The interplay of human action, spontaneous order, and decentralized knowledge continues to shape this dynamic ecosystem. How can we, as participants in this unfolding saga, harness the lessons of the past to foster a future of economic resilience and innovation? Share your thoughts and join the conversation in the chat. Unveiling the shockwaves. Crypto legislation faces unexpected setback. Coinbase's abrupt withdrawal from supporting crypto legislation reveals deeper issues that may reshape the market landscape. The recent decision by Coinbase to retract its support for a Senate market structure bill unveils significant concerns, particularly regarding potential bans on rewards and constrained regulatory flexibility that could adversely impact everyday cryptocurrency users. In examining the situation, we find that a Coinbase executive highlighted critical flaws within the proposed legislation that prompted this sudden change of stance just hours ahead of a planned legislative markup. This scenario underscores a deeper tension between traditional banking frameworks and the evolving business models of cryptocurrency enterprises, a conflict that is increasingly coming to the fore. The remarks from the Coinbase executive emphasized the intense pressure within the legislative environment, defending the company's choice as necessary to protect the interests of its users. Despite this setback, there remains a cautious optimism within industry circles that a viable legislative path could still be navigated successfully before the upcoming November midterm elections. Reflecting on these developments, we are reminded of the dynamic interplay between innovation and regulation. How do these forces shape the future of cryptocurrencies and the broader financial ecosystem? Engage with us in the chat to share your thoughts and insights. United Front, crypto's new harmonization era. A joint initiative promises to align and clarify the crypto regulatory landscape, heralding a new era of cooperation between key U.S. market bodies. In a bold move to synchronize the landscape of digital assets, the United States Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, are joining forces to advance a unified agenda. With the recent inauguration of Mike Selig as the CFTC's permanent chief, a collaborative event underscores their shared vision for crypto oversight. The partnership between SC Chairman Paul Atkins and CFTC Chairman Mike Selig represents a significant step toward reducing regulatory friction in the burgeoning crypto markets. Selig, having transitioned from a senior role in the SEC's crypto policy division, is poised to lead the CFTC with a fresh perspective. Both leaders have committed to a joint effort to eliminate jurisdictional ambiguities that have historically impeded market innovation. In a statement, Atkins and Selig emphasized the necessity of harmonizing regulatory frameworks to foster innovation under American jurisdiction. They articulated their intent to dismantle outdated silos that have previously constrained market participants. This collaboration is part of a broader initiative to ensure that the United States remains at the forefront of technological progress, benefiting investors and consumers alike. The upcoming event at the CFTC headquarters in Washington aims to solidify this alliance. It will feature introductory remarks from both leaders, followed by a panel discussion exploring the future of digital asset regulation. This gathering marks a pivotal moment in the ongoing efforts to define and structure the oversight of cryptocurrencies within the United States. The alignment of the CFTC's agendas reflects a concerted effort to address the complexities of the digital economy. As both agencies work towards clearer regulatory policies, the role of Congress in shaping the legislative framework remains crucial. The event promises to be a cornerstone in establishing a cohesive strategy for managing the challenges and opportunities presented by digital assets. In a world where economic calculations and individual choices drive progress, how can we ensure that regulatory frameworks evolve to accommodate the dynamic nature of innovation? We invite you to share your thoughts and join the conversation in the chat. Gold's ascendancy and Bitcoin's unyielding trials. The golden surge dazzles as Bitcoin grapples with its narrative, leaving many questioning its trajectory. The rally of precious metals continues unabated as Bitcoin and the broader cryptosphere face introspection and reevaluation. Gold has ascended by 1.7%, reaching $4,930 per ounce on this Thursday, while silver increased by 3.7% to $96 per ounce. Meanwhile, Bitcoin has retreated to just above $89,000, marking a decline of approximately 30% from its all-time high earlier in October. In the ever-evolving landscape of value, both Bitcoin and gold navigate parallel paths. Yet, Bitcoin's recent lackluster performance has prompted Jim Bianco of Bianco Research to ponder the fading resonance of Bitcoin's adoption narrative. The adoption announcements are not working anymore, Bianco declared in a post. A new theme is essential, but it remains elusive. Eric Balchunas, a senior analyst at Bloomberg, countered by highlighting Bitcoin's consolidation phase following an impressive rise from below $16,000 during the depths of the 2022 crypto winter to its peak at $126,000 in October 13. It surged 300% over the prior 20 months, Balchunas noted. Is it reasonable to expect 200% annual gains without pause? Contributing to Bitcoin's recent struggles, Balchunas pointed to early investors capitalizing on profits after extended holding periods, likening it to Bitcoin's silent initial public offering. An illustrative case involved an investor who divested over $9 billion in Bitcoin this July after a decade of holding. Bianco emphasized Bitcoin's underperformance across 14 months since the election victory of November 2024. He noted Bitcoin's decline by 2.6%, while silver rose by 205%, gold by 83%, and market indices like Nasdaq and S&P 500 by 24% and 17.6%, respectively. And as we await a new narrative, everything else accelerates while Bitcoin remains mired. Balchunas offered a final reminder that in November 2024, Bitcoin had outshone gold with a 122% year-over-year increase, suggesting metals have been striving to catch up. In this unfolding drama of value, we witness the intricate dance between established and emerging assets. The dynamics of choice, valuation, and market behavior are ever present, challenging us to discern the forces at play. How do we navigate a landscape where narratives shape perceptions, yet reality unfolds through unyielding market forces? Share your thoughts and join the conversation in the chat. Bitcoin's ascent, a new era of financial order. Bitcoin's institutional embrace and the rise of tokenization signal a seismic shift in digital asset growth, set to transform the financial landscape by the end of the decade. ARK Invest's latest insights reveal a transformative period where digital assets are evolving from speculative endeavors to foundational elements of global finance. This shift is driven by blockchain technology, institutional acceptance, and clearer regulatory environments, paving the way for a robust financial framework. Within their comprehensive report, ARK Invest delineates how digital assets, particularly Bitcoin and tokenized entities, are moving swiftly from trial phases to widespread implementation, surpassing conventional expectations. Bitcoin's emergence as an institutional asset is underscored by the substantial increase in holdings by United States exchange-traded funds and public entities, now comprising 12% of the total supply. This marks a notable rise from under 9% the previous year. The report further highlights Bitcoin's maturity as a store of value, evidenced by its risk-adjusted returns, outperforming most major cryptocurrencies and crypto indices. It is anticipated to maintain its dominance in the digital asset realm. ARK Invest forecasts the market for Bitcoin and smart contract networks to expand annually by approximately 60%, potentially reaching $28 trillion by 2030, with Bitcoin contributing to 70% of this value. ARK Invest envisions Bitcoin's market capitalization will grow from $2 trillion to an impressive $16 trillion by the decade's close. This growth is attributed to its role as digital gold and increasing institutional involvement. Additionally, the proliferation of stablecoins and tokenized real-world assets is seen as a crucial factor for wider adoption. Regulatory clarity in the United States has encouraged financial institutions to reconsider their stablecoin and tokenization strategies, leading to stablecoin transaction volumes that rival major traditional payment networks. ARK Invest identifies tokenized United States treasuries, commodities, and equities as pioneering indicators of a broader financial shift to blockchain. Although the market value of tokenized assets is currently modest, it is projected to exceed $11 trillion by 2030. This growth is driven by the migration of sovereign debt, bank deposits, and public equities onto blockchain platforms. Decentralized finance platforms and crypto-native issuers are closing the gap with traditional financial technology firms in terms of assets under management and revenue efficiency. Collectively, these trends suggest a future where public blockchains support financial systems globally. While adoption will be gradual, early recognition of this shift by investors and institutions may provide strategic advantages as digital assets become integral to the financial ecosystem. In contemplating this transformation, we must ask, how can we, as individuals and institutions, prepare for a future where digital assets and blockchain technology redefine the very fabric of financial systems? Share your thoughts and join the conversation in the chat. Thank you so much for following BlockSonic today. See you soon with more news, analysis, and market alerts. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.